In this video, we're analyzing option dealer supply and demand zones. I think one of the best ways to illustrate this concept is to look at a chart of the SPY. We've got two zones identified, the red dealer cluster zone notated by the G1 level and the green dealer cluster zone notated by the G2 level. If we zoom in to the chart here, you can see over the course of about 2 weeks from the middle of June until about the first week of July, the SPY was trading around this zero gamma level. Zero gamma is the neutral point in the market where gamma flips from positive to negative and vice versa. Here in this period, we see that price was really just oscillating back and forth around the zero gamma level for a couple of weeks. And then all of a sudden we had a breakout the first week of July up into this 555 level. This 555 level is right in our dealer cluster zone. So what are option dealers doing in this zone? Well, a couple of things are happening here. One, as price moves above this 553 gamma exposure level, which is the largest concentration here when we're looking at our graph, option dealers will be forced to sell shares of the underlying security the higher price goes above this 553 level. And that's based on the nature of the hedging requirements that option dealers have. But simultaneously, while dealers are selling in order to hedge their exposure at the 553 level, there's something else happening here. If we zoom in, the 555 strike is also showing gamma exposure growing. If we look even further up, we see the 560 strike is also seeing gamma exposure at that level growing. A lot of call buying is coming into the market at higher and higher strikes. And option dealers are selling calls to these call buyers and buying shares of the underlying security in order to hedge those positions. And so there's a little bit of a push-pull going on here around the 553 and 555 strike levels. This zone is a major supply zone as it currently stands. And so what often happens is we'll see a rejection from this level where price trades down for a period of time, or we'll see a consolidation where price basically trades flat in between this 550 and 560 level. And it's because of this activity that these supply and demand zones are formed. So here we're looking at Tesla having an insane like 30% ramp over the last couple of weeks. And interesting enough, let's just come over here to our gamma exposure data graph. When we look at this graph, we see a number of things. One, gamma exposure is still growing all the way out to the 300 strike. So Tesla's currently trading at 251.52, and there is large positive gamma exposure between the current price and all the way up to the 300 strike. So there is a lot of interest here at higher strike prices from market participants. And when we zoom into the recent price action, we can see that our identified dealer cluster or our identified supply zone is still higher than where we're currently sitting, right between the 255 and 260 level. So there could be another ramp up here in the coming days. We'd expect some temporary pause at that point. But if you look out further in time, you can see even if there is a temporary pause or slight reversal, currently market participants are expecting further upside even beyond 260, potentially to 300. So those are levels that we would be watching in the coming weeks based on the current gamma exposure structure. And so you may be asking yourself, how do we know how heavy the supply or demand levels are? Like currently we're looking at a potential supply level between the 255 and 260 level. So is this a zone that we should be selling in? What are the probabilities telling us? How do we know if this is a major supply zone or maybe just a temporary resistance level? And that's where zooming out and taking a look at the bigger picture goes. The larger gamma exposure data graph, as I mentioned, is telling us gamma exposure is growing all the way up to the 300 strike. So there may be a temporary pause between the 255 and 260 levels. However, Tesla is in a positive gamma environment. You can see here as we measure our total gamma exposure, we are positive by nearly 200 million. Now, 200 million is kind of a meaningless number if you just take that by itself. So what we do is we look at the historical ranges measuring gamma exposure, which you see here on our gamma exposure intensity gauge, to really get a clear picture of how positive or how negative gamma exposure currently is for each particular security. So Tesla in this example is sitting at positive 200 million. You can see that we are well into the positive zone on our gamma exposure intensity gauge. And this is just telling us market participants are bullish. Even if we see some temporary resistance overhead, we're not going to go in heavy short at those levels because overall the market is bullish, gamma exposure is bullish, and any option dealer selling that comes in is probably going to be offset because of all the call buying that's coming in. So there's multiple factors to consider. It's not just as simple as buy when it hits this level or sell when it hits that level. Let's just take a look at one more example here on Palo Alto Networks. Starting on June 20th, the price really started to ramp from around the 310 level all the way up into the 340 level. This occurred really quickly, just over about a week's time, right up into this dealer cluster zone here. And this is a classic example of gamma exposure. We're not seeing a major rejection at this level. Instead, what we've been seeing is price has been trading right into this supply zone and consolidating. And if you recall from the beginning of the video, we said typically two things happen when price reaches either these supply or demand zones. In this instance, we would either see a consolidation, a pause at this level, similar to what we've been seeing here on Palo Alto Networks. We've basically been trading here for about 10 days around this 340 strike price. Why? Because this is a supply zone. The second possibility when price reaches these supply zones is that we see a large rejection, retracing back to where the previous supply zone was, which in this instance would be in this area. So considering what we've discussed so far, why is Palo Alto Networks price not rejecting back to the previous supply zone? Why instead is it consolidating at this level? If we come over here again to our gamma exposure data graph, we can see several factors identifying bullish positioning and potential further upside. Number one, we're an extremely positive gamma exposure environment. This is essentially telling us buy the dip, sell the rip, but price will continue trending higher. If we look down here based on the strike levels, we can see gamma exposure is reaching the largest concentration here at the 340, 345 level, but we still have large gamma exposure growing at 350, at 360. This to us would be indicating that price is consolidating at the current supply level for a potential leg higher. That is where the probability lies because gamma exposure is growing at these higher concentrations, which essentially means that open interest is growing at these higher concentrations. And if we just look over here at the put call ratios, calls are outpacing puts on an open interest basis. Puts and calls on a 30-day basis are about even. But if we look at 90 days, huge call volume. Even if we look more short-term, 10 days, 20 days, much larger call volume coming in. And so these are all factors letting us know that there is continuing call buying coming in at higher strike prices. And so ultimately, this consolidation that we've been seeing over the past 10 trading sessions is indicating that the probability is for another leg higher. So how can we create high probability trading strategies using this data? Well, that's one of the beautiful things about the options market is that you can construct trades that have defined risk and know your probabilities ahead of time. Let's just take a look at an idea that we posted in Discord at the beginning of June. This was on Meta. We were looking to add a few call spreads to our educational portfolio. As an example, 495 500 call spread with the June 28th expiration. Take a look at the gamma exposure structure and the volume structure on Meta in this example. Meta was trading at 472 at the time. You can see a large consolidation zone where price had basically been consolidating, tagging this dealer cluster once or twice in that time frame. But take a look at the gamma exposure. Large concentration at 500. You had big volume coming in as well at 500. Strong volume as price traded higher here into this 480 zone. All this pointing to the probability that Meta would continue higher up into these levels. And so check out what happened. I just want to show you this on our trading view chart here. You can see this was the area we highlighted through the month of May, this consolidation that was taking place. On June 3rd, we posted the idea with the large gamma exposure concentration at the 500 strike. And what do we see? a big ramp up right into that 500 zone. And so let's go back to our original idea. We've got the big 500 strike here notated by our G1 level, which is the largest gamma exposure, and our supply zone on Meta. Price ultimately ramps into this zone. And then what happens? Is there a rejection? Is there a pause? Does price run through that level? Let's take a look. Price ramps right into that 500 level again, which is our dealer supply zone. And what happens over the course of the next several weeks? Price is basically just trading in that zone 500, 510, just bouncing around for several weeks. Why did that happen? That is our dealer supply zone. This is why supply and demand zones are so important, but not just arbitrary supply and demand zones looking at historical data, true supply and demand zones, looking at current market data, where market participants are positioned in the options market. How are option dealers responding to these levels? What kind of activity are dealers selling? Are dealers buying? That's going to give you a lot of information about what is happening in these supply and demand zones. That's actually one of the things that we teach in our Geek University. This is a free course that's available to all of our members. It's a 5-hour course where we discuss an introduction to option strategy, volatility, gamma exposure, and an overall trading strategy based on a risk management and portfolio management framework. If you guys are interested in becoming a member, go to geeksoffinance.com. Check out our site. We've got 2 membership tiers. We'd love to have you join us. You'll get access to our Discord, to our Geek University course, as well as to our gamma exposure dashboard. A lot of great information, and we teach you how to use this data to identify supply and demand levels and incorporate those into your own trading strategy. So definitely check that out when you get a chance. Thanks so much, everybody, for watching this video. I hope you were able to find value in it, and we will see you guys in the next video.